Hey everyone, welcome back to the channel. So in this video we are going to make an in-depth video on how to buy stocks. This will be a full all-inclusive tutorial showing you how to invest in the stock market. Right now there is a heavy interest in the people trying to enter the stock market, and so many people are interested in investing. Please note that I'm not trying to sell you any course. I'm not affiliated with any of the companies or brokerages. If you open an M1 account using the link provided below the video, I will get some referral bonus, but that's about it. I'm not going to make any profit on this video. I'm doing this video to help someone learn about stocks. What I'm going to do here is I'm going to break down this into a couple of different sections. First of all, we are going to talk about a lot of common questions that people have of how to actually start investing. What brokerage firm should I use? And how much money should you start with? What are some of the initial techniques that you can use to find stocks, or what type of investor you should be? Then later in the video we talk about market research. We are going to talk about qualitative versus quantitative research. We will also talk about looking at different income statements such as balance sheets, cash flow statements, and we are really going to try to go in depth as much as possible. So if you want to watch more videos like these, the only thing I ask is to you subscribe to the channel and drop a like if you find the value in this video. Now let's get this thing quickly out of the way. Who and when should buy a stock? The general rule is that first you should pay off any high interest debt you have before investing. That's like credit card. These are not good to have. Mortgage is the long term and usually has less interest, so that is okay. Also, you should have an emergency fund separate for 6 months of expenses. Only after that you should start investing. Also, never borrow to invest. The second question is, how do I actually buy a stock? Well, we'll again touch on this very briefly because I think some of you already know what kind of account do you need and how to go about this. You could easily do a Google search, but there's a couple of brokerages I really like, and there's also a ton of them new ones which you probably never heard. So brokerages like TD Ameritrade, Fidelity and Vanguard, they are the more traditional ones, and then we see a lot of newer ones which have come out recently, which are like the Robinhood app and the M1 Finance. And the M1 Finance is one of my favorites. It doesn't really matter which brokerage firm you go with. A lot of them today are pretty similar to each other. They have very similar features. However, do remember that very few of them allow buying fractional shares. For example, if you wanted to invest in Tesla stock and looking at it, it's over $560 per share. So traditionally, if you wanted to buy one share of Tesla stock, you would need to actually have more than $500. You wouldn't be able to buy half a piece of Tesla share, right? Well, now you can do that with something like M1 Finance or Fidelity mobile app. You can start your accounts with about $100 or less for most of these different kinds of brokerage accounts. Now let's actually talk about stocks and what a stock specifically is, just briefly, because I know for some people that's been kind of a concern of what actually is a stock, how does it function. So the most basic way to put it in a couple of sentences here is that a stock is essentially just a piece of a company that you own. When you buy a share, you actually own a piece of the company. If you own one share, you're not gonna really have much say in the company, but people who own 10%, 20 or 30 of the company can actually vote on certain things that the company does. They can vote on the board members and even pressure the company into taking some decisions. It also depends on how much time do you have and want to devote to it. People who have more time buy individual stocks usually, whereas people who don't and want to still participate in the stock market usually buy ETFs or mutual funds. So now let's talk about stocks versus funds or ETFs. As we mentioned earlier in the video, a stock or a share of a company you're going to own is a piece of a company, but with ETFs, exchange traded funds or mutual funds, what these are going to do is essentially they are a basket of stocks that people can invest into. So say that you didn't want to pull all of your money into a XYZ stock because you want to diversify. You don't want all your money going into one company, because what if that company has problems next year and their stock price goes down? If the price goes down to a much lower level than what it is today, you can end up losing a lot of money. And so what some people like to do is they like to invest in ETFs and mutual funds. You can also diversify your portfolio by investing in stocks of various companies from different sectors. So not all stocks go down if one sector is not performing well. For the sake of this video, we are going to say that ETFs and mutual funds are relatively the same in the sense that they are going to represent an overall basket of stocks. So think about something like VOO as an index fund, which is run by Vanguard. Vanguard is a financial institution and you can open an account with them, or basically any other brokerage where you can actually buy VOO, and this VOO tracks the S&P 500. Indexes essentially show us how the markets are doing overall. For example, Dow Jones Industrial Average represents 30 companies in the United States. Then we have something like the S&P 500, which represents 500 companies in United States. This is probably the best indicator for how well the US markets are doing. Then there is Nasdaq, which is much more focused on tech stocks. But then throughout the world, as well as most countries or most regions in the world, are going to have some type of index that you can see how well that's doing. Now let's talk about some advantages and disadvantages of stocks versus ETFs. Some ETFs can have over hundreds of stocks. Let's say you invest $500 in the S&P 500 index fund. It means that you own $1 of each stock in that ETF. Let's say one out of those 500 companies goes bankrupt, and let's say that they have no money left to pay their stock. The stock price goes to zero, and if you buy an index company, now you have 500 companies out of which one went down. So the effect is not so much because the 499 other companies would still be doing well. So the downside risk is lower. On the flip side, if you say any one of these 500 companies turns into next Tesla, it absolutely booms and the stock price goes from $1 to $1,000 like Tesla did. Well, you're not going to see much of an effect from that as well, because the other 499 stocks might be sort of weighing it down. So you can see the kind of how that both it has positives and negatives to it. Now let's talk about different types of investment and trading strategies. The first strategy is day trading. This is where people buy the stock during the day and sell it off the same day. Or you could also, it's a form of a swing trading where you buy a stock in a company, hold it for a few days, wait for it to go up, decide that there is a certain percentage or points you want it to go up, and then sell it off. So that kind of consists of day trading and swing trading. Also, the next strategy is dollar cost averaging. Dollar cost averaging is when you keep buying shares in a certain company or mutual fund over a long period of time. Many people don't have the funds to invest a huge amount into stocks and build up a position initially. So what they do is they gradually put in some amount into stocks every month or say every other month and build up that position over long periods of time, so that they hold that stock and they can also collect the dividend and give it time for it to go up. This strategy has also been very successful for a lot of people in growing their wealth. Well, the next strategy is growth strategy, and in this strategy is basically simple. You buy a stock for a company which is in the growth phase. When I say growth phase, it means it's doing really well on the revenue, and the revenue is kind of growing more than 15 to 20% year over year. This kind of company does not give dividend, but it gives a lot of growth and upside to the shareholder. For example, you can take is again Tesla is a like a growth company. Facebook is, but now Facebook is also like becoming a very large company. So a lot of these small software or tech companies which are like where the prices keep growing up every day and they kind of keep going up, those are the growth companies where people want to invest in. They're also riskier because you never know what kind of company might fail, but at the same time there is a lot of upside potential to it as well. Now, dividend investing strategy is a strategy where you just collect dividends. A shareholder is just given dividends as a reward for holding the shares for a period of time. It's like almost getting free money for holding shares, and it's many people like that because, and even I do, because it's like getting free money for doing nothing, just holding the shares. You keep earning money over and over, and it kind of creates a snowball effect, and that kind of makes your initial capital just large every year with the growth of those dividends in your account. These dividends are usually like going between 3 to 4% is where like most of these dividend companies are there. Their growth is not so much, but they do keep growing steadily for years. Now, dividend growth strategy is basically investing in companies which are giving a dividend, but they have just started to give dividends and they are growing it aggressively, and it's going to get grown over aggressively over time, and it's going to get big. So it may not be very big just now. It could be like around 1% dividend yield you're getting on it, but at the same time it's growing at a very fast pace of more than 10 to 15 or even 20%. For example, you can take Home Depot out here. Home Depot's growth you could see is around 15 to 20% year over year on dividends. So those are the kind of companies which come consistent and come under dividend growth strategy. Even Starbucks does. Next is technical and fundamental analysis. Technical analysis is basically mostly used by day traders because they view different charts, volumes, and different shapes and trading patterns to decide when to enter and exit a particular stock. They do not use fundamental analysis, which is studying the stock, looking at their profits, their revenues, their books, their accounts, and calculating and taking decisions based on that. So technically is basically or a purely chart based decision making process and used by day traders, whereas fundamental analysis is what is used by long term investors when they analyze a company, see if the price they are paying for is worth the company. Are they paying a premium? Are they getting a fair value discount? Or what kind of a deal they are getting into? What does the company do? What's the product? Who are their customers, etc. All that research which goes into, and which most people who are not actively day traders use this method. Now, before you invest into any stocks, you should first do your research. Research is the main basis on which you take the decision of the company. So research is very important, which you need to do, and sometimes if you're not comfortable with it, you can go and approach a financial professional or a financial advisor who would advise you. But it is something which you need to do, and like I said, it's not something where you can just listen to me. With that being said, let's get into the first part of research, which is quantitative versus qualitative research. Now, qualitative research is something that you do along the lines of the company's culture. You look at the business model, you look at the vision, the leadership for the company. So you're not just looking at the financials, but you're also looking at the leadership. While quantitative data is actual figures and numbers to look at. This is the balance sheet and other sum and other income statements. Both of them play an important roles. So let's take, for example, Altria, ticker symbol MO, a company that primarily makes cigarettes and tobacco products. If you just look at the stock and you see it's doing well. Quantitative research shows that it has a great dividend yield of over 8% and its revenue is also increasing. But it's only when you look at the qualitative analysis you will see that the trend of smoking cigarettes is going down. Less people are consuming cigarettes every year. So the total addressable market is shrinking and they are just charging more money for their products to the same users to increase their revenue. That raises some red flags. So the next topic is financial statements under the research. I think it is one of the best ways in terms of gathering information to learn more about a company in which you want to invest in. So let's say you want to invest in a 3M company and you think that it's quite interesting but you don't know enough about the company. So well, it's very easy to learn more about the company through their investor relationship website. So on the investor relations portal, all you need to do is to get there is do a quick Google search and it will take you there. And on that website, if you go and see on their homepage, you'll be able to know more about the company, what are they doing currently, and what are they gonna do going forward. At the same time, you'll also get to see all of their reports which they have filed. It's a lot of information out there which you can get to know about the company which otherwise you wouldn't have got. Stocks listed on most stock exchanges around the world would be regulated and they would have some kind of information available to the public which is mandatory by the SEC. So it's very easy to find these. One thing we have to look on the website is the annual report or Form 10K. It is going to be a report looking at the past year, talking about the numbers from the past year and then talking about their future projections. For example, what is going to happen in the year 2020 and what kind of sales and projections they kind of expect in the company. Usually they write very, very positive things about the projections, so you just have to take it with a grain of salt, as well as they'll highlight what kind of achievements they have made throughout the year. This is going to be a very long report, so if you are really interested in knowing more about the company and doing a thorough research, I highly suggest you take out some time to read this. The website will also have quarterly updates which will show you for each quarter. They are also known as 10Qs. It is going to be essentially just a short update every quarter and what they are thinking is going to happen the next quarter based off looking back at their last quarter. Now next is the conference calls, or whatever you can also call earnings calls. These calls happen every quarterly, and this is where the CEO and a number of people from his team and analysts together talk about how the company is doing and how the quarter has been, and they talk about what the kind of earnings the company has done. This affects a lot on the share price as well, because if the company has overshot or met its expectations, the company's share price will go up. And on the flip side, if the company has missed its earnings of what it's going to expect in terms of revenue and targets, the price of the share will fall down. You can see these dips and rises around 4 times a year, which happens the day the conference call happens and these results come out. This can be clearly seen on the graph as well. Over here on the 3M website, you can see that You can scroll down over here and it's clearly on the investor relations website. It shows that the Q3 results out here. It also has it in an MP3 format, so you can listen to the whole conference call, as well as it has the transcript where you can just click and read through whatever was discussed on the call. Anyway, it's a great resource over here. So our next point is ratios. Ratios are basically ratios which kind of help you understand if the company is expensive, what is its forward earning going to be, what is the earnings per share the company is kind of going to return. And these are things which I can't explain just online right now, because it's a very deep topic and you need to take out time to understand what I'm trying to say here. You need to go to either a friend or take some kind of an online course which helps you understand these different types of ratios. Ratios could be found on most any website, financial websites. It will, for example, over here you can see on Seeking Alpha, over here we have the EPS, earnings per share, price to earning ratios, in dividend forward. So there are many ratios like these which help you understand the financial position of a company. So you need to know these. You can go and say, for example, like I have put out, you can have Seeking Alpha out here, you can go on CNBC and they'll have few basic ratios available out here as well as you can go to Yahoo Finance and they'll have it on the front page when you type in the ticker symbol. So the ratios are quite helpful, but again, it's something which you need to takes time to learn and understand what each of them means and how to apply them. The only way to get better at investing is that you need to learn more about your companies, you need to read a lot more, you need to talk to people, friends, ask people who are already doing investing in shares, how they do it, go online, do more, watch more YouTube videos, follow investment legends like Warren Buffett and Peter Lynch, so you get the idea of what their philosophy is, and then you can create your own investing style. If you want to know how to pick specific stocks and select which stocks to invest in, I would request you to go to my earlier videos and see the ones which I've made on how to select a stock, and that should give you a good idea about it. Now that we have talked about what are the different investment strategies, what are mutual funds, index, all the different types of research and trading strategies, you now have a lot of knowledge to go in, and this will give you a boost to begin your investment journey. If you have made it till here, then congratulations. Give yourself a clap and know that you are one of the very few people who has actually taken their first step into investing, because many people I know, they don't even know anything about investment, they don't even invest in shares. So you have taken that first step towards your financial freedom, so it is now time to enjoy and celebrate your upcoming success. And I wish you all the best.